based on how those problems, multiple choice are pretty good. Since they gave you about 10 that were on the quiz, so a lot of people did pretty good on that. That's pretty sad. But anyway, it's a good thing because some of those test questions, you guys don't know what an equity statement is, do you? An equity statement, you show common stock, additional paid-in capital if you have it, preferred stock, additional paid-in capital if you have it, in columns. You guys read about this. And then you have other comprehensive income columns, and then you have retained earnings columns. You might have appropriated and non-appropriated. So it's a spreadsheet for companies, right? And then it goes down from the beginning balance to the ending balance. You guys all give me a retained earnings statement. And some of you plugged in contributed capital, you thought, well, it's got to be equity. Change the name to equity. Luckily, that was only 3 points. So, but that statement is pretty funny. I'm like, what is this stuff? So, anyway, we'll work on it. You'll work on it. Comprehensive income. Okay, what's the deal here? Remember we said that we had did you notice over there I gave them some of the answers? It's nice for my principal students where the markers go. It was just, is there one on the table there? Sorry. It's none of the house. We'll use this real quick. When they left it for us. Somebody wrote on the wall. It wasn't me. It's a very nice setup here. Who is that? Okay, anyway. Told you guys. In the other room, there's actually blackboards on each side. What I asked for was a blackboard here. Just give me a big blackboard here, so I have something to use. Guess where they put it? Behind the screen. So I can turn anything off, raise up and down. So, it's not multitask here. Okay, anyway, yes. Now what? I'll probably have ink go through this. Maybe it doesn't put a blackboard up. I can just write all over those walls and it might get good. Okay, anyway. You guys do know that we have assets equal liabilities plus equity, revenues less expenses is net income. So let's figure out where comprehensive income comes from. This is another one of those things where I like to figure, right? Yeah. There's contributed capital, which is common stock, additional paid-in capital on that, right? Yeah. Preferred stock, additional paid-in capital on that. Maybe donated capital, different types of capital, okay? And then there's also the treasury stock, come back out of that, right? Divide that to treasury stock. All right, and then there's retained earnings. Everybody agree with that? Retained earnings has what in it? Your net income, which includes all your revenues, all your expenses, all your gains, and all your losses, right? Okay, whether they're an extraordinary, discontinued, or inactive, right? Anything that runs through retained earnings, of course. Okay, then there's another category in here. Other comprehensive income. And the way to define this thing is everything that is not due to your net income, earnings process, right? Revenues, expenses, gains, and losses. Everything that is not that, and is also not a transaction with the owners. What are the transactions with owners? The owners invest in the company, right? Maybe you buy the stock back from them in treasury stock. And what else? Transactions with owners. Dividends. Got it. That's it, right? So those things, of course, are in retained earnings and in contributed capital, right? So what this stuff is the stuff we don't know what to do with. Where does it go? Other comprehensive income. So we'll get to that in a second. When we say comprehensive income, what we mean is the other comprehensive income for the year plus the income for the year, right? So comprehensive income includes what's on your income statement plus what's in the other comprehensive income category. Got it? Those two added together. So it's comprehensive income. Other comprehensive income, obviously, is just the portion that's in the middle there, right? Comprehensive income stuff. Got it? Yes. So the definition again is it is all sources of income that are not included on the income statement, right? Or I'm sorry, go better way to put it. All changes in equity. All changes in equity. Correct that. All changes in equity that are not due to transactions with owners, contributed capital, dividends, or income, right? Got it? In the income statement. And if you read the definition, they give you that's exactly what that says. It is, isn't it? So, big deal. Look at that. What does it say? include all revenues and gains, expenses and losses reported in net income, and all gains and losses that bypass net income that affected stockholders' equity. Okay, give you some examples of those. Give me one that we did in principle. Unrealized gains and losses on, well, not all stocks, because trading securities goes where? To the income statement, right? That gain or loss hits the income statement. We recognize it in the current period because it's real short term, right? We're holding the stock for a short period of time. We're going to sell it real soon, so we think that's a real gain. We should recognize it in the financial statement as a real gain or loss, right? Recognize it. Available for sale. Available for sale securities, whether it's short term, up to a year holding it, but longer than a few weeks, like the trading securities, right, guys? Yeah. Up to, and then the long term ones too. All those gains and losses go where? Other comprehensive income. Also, expenses for pensions. In prior years, we were not funding pensions. The law changed, and now people have to fund their pensions, right? So you guys know about the precedent. That's why the pensions are not funded, and now the companies are going broke. Governments are going broke. The state of Kentucky, where we had a 9% budget cut across the board from our new governor to pay for pensions, we failed to fund. Right? And then also people expected that the stock was going to keep going up, and when it goes down, of course, they can buy mad, right? Ridiculous. Okay, so, anyway, so that is a reality, right? So what happens is now we don't know what to do with the gain or loss. Okay, the expenses. We're going to credit the obligation. We wanted to make the obligation correct on the balance sheet. We didn't know what to debit. Nobody wanted to take all the retained earnings debited. Nobody wanted to put it in the income statement as a loss and then take it out of retained earnings. So we put it in other comprehensive income. Do you think reading other comprehensive income is important? You can see that their equity might be deficit because of other comprehensive income. Got the idea? The other one is foreign currency translation goes in. Because the rates keep changing, so we don't want to put those gains and losses in the income statement. Some situations we do. Okay? So and I'm pretty good with. And actually, I think the alternate sales securities I'm fine. Although I think the trading security ought to be 1 year, right? And then it'll only be long for the bill. That was the original idea. But it's a political compromise. You read about GAAP, it's generally accepted accounting principles. There's political compromise, huh? Yeah. There's one of them, right? Start out with, no, everything should be income statement on available sales securities, right? And well, no, only the short-term ones should have. And then no, only trading securities, which are really short-term. And then people thought, well, that'd be maybe 90 days. The application of it turned out to be like 2 weeks. And then what companies just say is, I'm not holding any trading securities. We're going to hold it for that over a year. So, right? Of course, when you're auditing, you look at to see if they're turning them constantly. They're trading them every day. Come on, they're trading securities, right? Okay. So anyway, all right. And by the way, you should never trade stocks every day. If companies can, their trading costs are minimal. You can use loss. So if they just park them, that's fine. So if you guys ever do it, don't be a day trader. It's guaranteed way to lose your money. Right? Unless you just really, really get lucky gambling. It's not quite as bad as going to casinos. It's close. You have trading costs buying, trading costs selling. What's the odds of getting enough gain to pay for those? And by the way, might you get lost a given day, of course. So day trading is nice. Anyway, let's go there. All right. So here's what it might look like, huh? Net income plus other comprehensive income. That's not what it looks like. But what kind of things are they? Unrealized gains and losses on available sales securities, translation gains and losses on foreign currency, and others. Okay? It's all reported in the stockholders' equity. Fantastic. We're thrilled. Oh, you can answer these, please. All right. Companies must display the components of comprehensive income in one of 2 ways. A single continuous statement is a one-statement approach, where what you do is you come down to your net income, right? Regular net income after tax, right? Include the discontinued operations and extraordinary items. Very good. And then you go on that statement and explain why. The other comprehensive income items for the current year. Nobody does that. Almost nobody. A few do, but almost nobody does. Why? I didn't want the other comprehensive items on their income statement in the first place. That's why they're in other comprehensive income. So they don't want to put it on the face of the income statement, so most companies don't. 2 separate ones, right? You could show one statement and then on another page show another statement. Companies prefer that over the first one, don't you suppose? Because they got an income statement that doesn't include this, and then they do add it later. Okay, show it later. They start with the net income and add the other comprehensive items, income items, either increase or decrease. Okay? So here's the one statement approach. Just keep going, right? They only add one unrealized holding gain net of tax. fine. Advantage does not require creation of a new statement. Disadvantage, net income varied is the subtotal in the statement. Okay. And also, you tell them about this stuff. It's a gain, that's okay. It's a loss, you don't like that so much. Okay. Everybody loves gains. Two-statement approach, see they show two different statements. Okay. And there's really a third one. What a lot of companies do is they just show it on their what? The one you don't know how to do. Equity statement, okay, on their equity statement. All right, the reports the changes in each stockholder's equity account and total equity for the period. Following items are disclosed in the statement. By the way, when I tell you guys you don't know something, it's not all that shocking to me that you don't. There's a lot to learn. It's just learn it. Okay? Hurry up. Time's going by. You're getting old, even as we speak. Okay? But, you know, as fast as you can. As fast as you can. I'm going to give you all kinds of things you don't know how to do on tests, I promise you. I did promise that, didn't I? Yeah. The quizzes and tests, you won't know how to do stuff. Yeah. What's wrong with you? I could do it. I'm old. Come on, get with it. Okay? So anyway, well, maybe I can do it. Reports the changes in each stockholder's equity account, total equity for the period. Okay, so issuance of shares, distribution of dividends, reconciliation of the carrying amount. No, yeah, okay, great. So here's what one looks like. Isn't that lovely? And, okay, so this one, they showed routine earnings first. That's ridiculous. Most people show common stock first, but you can do whatever you want. Common stock first, then additional paid-in capital on common stock. Columns flow, right? Preferred stock, additional paid-in capital on preferred stock. Anything you got, donated capital, whatever you have, okay? And then you work your way across, right? Have accumulated other comprehensive income and have retained earnings, and you'll show then in total, right, on one end or the other. Some people put it on the left side, some put it on the right. You have total equity, and you can see there's net income, other comprehensive income, unrealized gain, holding gain or loss. They're showing that it's in there. What would you have? They don't have everything here, obviously. What else would you have? Net income or loss, dividends, right, guys? Issuance of stock, all kinds of things. Okay? So in this, what happens? The balance sheet, we show now not just common stock, or not just stock, right, paid-in capital accounts, and not just retained earning accounts. We now have accumulated other comprehensive income account, right? Take the beginning accumulated income, add or subtract any changes, and you get your ending. Do you close those accounts? Any of those? No. So what's on the income statement gets closed to retained earnings. What's in other comprehensive income stays there, right? You just adjust it year to year, the beginning balance to the ending balance. So cool. So wait. Can you go back real quick?
So, when you were to sell the other comprehensive income and you realized that it would just...
Well, you can't sell other comprehensive income, but you could sell shares of stock, for instance, or that's what you can. Yeah. Available for sale securities, and you sell them. Yeah, what's your question?
Where did you...
pretty good.
Where did you debit other comprehensive income and then credit accumulated?
Well, what would happen is you would eliminate the gain or loss that's included in other comprehensive income. So you debit cash, right? You credit the asset, but remember you've adjusted the asset to its market value at the end of the previous year, right? Because that's what we do. If the market value increases, we debit the stock account, right? Investment in the stock, investment held, investment in available for sale securities. So we debit that, credit the gain, don't we? The gain would be another accumulated other comprehensive income. Or if it's a loss, the reverse, right? Credit the asset, the investment, and debit the loss. Okay, and the loss would be in here. So the summation of all the gains and losses of your stock that you're holding for any period of time at all, right? Available for sale are in there. So now when I sell one, I would debit cash. And I credit that investment in the account, right? That represents the market value at the end of last year. Okay. And you're right, I take the gain or loss out of here, and now I put my income statement. But it's a different gain or loss, of course, because the value changed, right? Yes. Yeah, but all the current years changed. It's going to hit the income statement, but so will the product too. Okay, so that's exactly right. That's what you have to do. Not a very big deal when we start doing this, right? Later, when we start doing this, but it feels like it is. Just because you got a different account that you're running through. Okay, so just make that clear. Good question. I like that question. Thank you. All right. Is there a better equity statement than that in here? If they showed a little better presentation, I guess not. of a real company. Pull up Target, okay, and or Papa John's or something. Pull it up and go to their other company or go to their equity statement. You can see what one really looks like. Here you have to just imagine more columns, right? Going across. These things will be 2 pages wide, right? The idea, but not usually very many lines long, depending on how many different things they've got going. Okay. Always read all the IFRS stuff. You know about the conversions. They keep talking about it, right? Similarities. GAAP and IFRS require companies to indicate the amount of net income attributable to a non-controlling interest. Both do now. Didn't used to be. Both GAAP and IFRS follow the same presentation guidelines for discontinued operations. IFRS defines it more narrowly. Okay, they're trying to work together in a joint project for that. Both GAAP and IFRS have changed items that are recognized in equity as part of comprehensive income, but do not affect income. Right? They allow 1 or 2 statements in preparing it. Yeah, sure. Differences. GAAP follows either a single or multi-step income statement approach. IFRS does not have a single step or multiple step. Right? In addition, under GAAP, companies must report an item as extraordinary, if it's unusual in nature and infrequent. No such thing under IFRS. We looked at that before, mentioned that before. Under IFRS, companies must classify expenses by either nature or function. GAAP doesn't have the requirement, but the SEC requires a functional presentation. So most people do functional by function, administrative, right? Separate from selling, separate from research and development. So by function. Okay, IFRS identifies certain minimum items that should be presented in the statement. GAAP has no minimum information requirements. I think they're better here. However, the SEC has more vigorous presentation requirements, but still not very much detail. IFRS does not define key measures like income from operations. SEC regulations define a whole bunch of them. So when we went through, you're supposed to name things, right? Put it in the right order. Operating versus non-operating. Sales, less cost of goods sold, gross profit, right? Less operating expenses, so on, right? So we have a lot more detail about how to do the presentation, even though we don't require as much disclosure, not as many lines. So it's interesting. Okay, under IFRS, reevaluation of property, plant, and equipment, and intangible assets is permitted. And it hits for other comprehensive income. We don't do that, not yet. So you can see there's still, the reason I mentioned this is there's still convergence happening. Okay, used to be they were really different, and people actually made their careers by learning international financial reporting standards and U.S. GAAP and being able to convert one statement to the other. That's going away. This is an interesting thing about professions. You might become a real expert at something, your career takes off, you even make partner with it, and then they'll change the rules and what you know doesn't matter anymore. And what do? Keep learning, keep going, keep working, right? Things change. It's a big deal, right? You're supposed to learn your entire career. Just keep going, keep adding skills, okay? So if you go to tax practice, they really change tax laws sometimes. Oh, it's sort of like a guaranteed employment act. Every time they do a tax act, guaranteed employment for tax accountants and tax attorneys. Why? You have to know the old law, you have to know the new law, and you have to know how to transition between them. And you wait for the next change. You make all kinds of money. You're working a lot of hours trying to figure that out. They usually call it tax simplification acts too, by the way. Yeah, never seen one make anything simpler, but oh, anyway. So they're talking about the project to restructure the statements, and they may make the statements completely different. So enough on this chapter. Good job. All right. Let's go to 5. And again, we'll start cranking numbers when we're done with chapter 5. And you have been doing problems, right? In 4, and you'll be doing them in 5. There's numbers to crank here, right, guys? You're just not using class time for that. We'll use the review to do that. I'll work any problems you guys have been working on, or working with you. Try to figure them out. Okay. But I think it's useful in these 2 chapters to just go through this PowerPoint and talk about what's going on. There's a lot of these chapters. Imagine, by the way, a quiz question where I list 20 accounts and ask you where they go in the financial statements. Or I give you 20 accounts and ask you to do financial statements. Right? What would you do with leasehold improvements? What would you do with goodwill? What would you do with purchase commitment obligation for the liability? I mean, you don't even have to know what it is. Okay, so and would you know what to do? Can you tell assets from liabilities from equity expenses, the gains and losses, you know all those things? You know where they go in the financial statements? I doubt it. But you will when I hand you a quiz, right? Okay. Be able to do this. And I'm going to find exotic accounts. I'm not going to give you simple ones. Why would I do that? I know you know what land is. You understand. It's an expense, right? Like, anyway, so somebody will listen to this sometimes and say, oh my God, doesn't land's an expense. No wonder balance sheets don't know. All right. So what do we do with the balance sheet? Let's go on over to chapter 5. Yeah, the real name is the statement of financial position. There you go. It's right there. They actually show us one on page 213. Look at that one. Does that look familiar to you guys? Page 213. Take a look at that statement. Does it look like a balance sheet to you? I think they put a company name on it, a date on it too. But well, they did. Yeah. What is this? Statement of financial position, business operating, and then investing, and then financing. That sounds like a cash flow statement. Cash is way down at the bottom. Wow. And then discontinued operations, income taxes. What are they doing? Equity. That's going to be maybe. That's what they're working on. The new joint statement that the FASB, the International Accounting Standards Board, are working on. That's what it might look like. So I am having you learn exactly what a balance sheet looks like, huh? And having you learn exactly what an income statement looks like under U.S. GAAP. And then they're going to change them. Hopefully after you take the CPA exam. Oh, here's a deal on that too. If there are changes in the 6 months before you take the CPA exam, they won't be in your exam. And even if they are, they'll be experimental questions. They always put, when they write new questions, they put them on the exam and see how people do them. Because if nobody gets it right, it doesn't measure anything. If everybody gets it right, it doesn't measure anything. If there's a mistake in the question, it's really tough to write these questions. So it's a big deal. Richard Schrader used to like to go to New York and write questions for him. Students guys. So he really enjoyed that. They paid almost nothing to do it, but it's sort of a donated of their time. And he thought it was fun. Anyway, so they have people who know what they're doing, in other words, writing the questions, checking each other's questions, but everybody's trying to work it. And still they get through it. So my point is, if it's within 6 months when you take the CPA exam, you're not going to be expected to know that. Okay? If it's a year, there'll be at least experimental questions about it on the exam, right? If it's more than a year, you're going to get tested on it, and probably heavily, because it's the new stuff. It's what they kind of like it, right? So be watching. So we try to stay current, of course, right? And try to keep you guys current. Here's another thing. Don't wait 5 years before you take the CPA exam. You're done in. All you'll remember is the stuff you're currently using in your career, all the stuff you're not doing. If you do not become a tax accountant, how good are you going to be at taxation 5 years into your career? Or if you don't become an auditor, how good are you going to be at auditing 5 years into your career? You're probably better off to take the auditing exam right after auditing if you're going to be a tax professional, for sure, right? Besides, even if you're going to be an auditor, you don't study the stuff you learned in class, the theory. You do auditing, right? It helps, by the way, on the auditing section exam, you already worked as an auditor. It helps on the tax questions, obviously, if you've been doing tax as a career. But you're going to be weak somewhere, right? Because you're not going to be doing everything. Well, maybe you go to work for a real small firm, you might do some of all of it, and then you'll be kind of weak in everything. Because other people would have more expertise in the thing they do all the time, huh? It's kind of the way professions go. You can't know everything about everything. So what's my advice? Take that exam right away. As soon as you are qualified, you take that thing. And you keep taking it until you pass it. And if you do things right, if you start working in here, right, I mean really working in here, you are going to be able to pass this stuff the first shot. It's going to be over. You're not going to have to study for it. You guys are all working at different levels right now. Some of you aren't doing too bad. Nobody's stellar. Nobody's stellar. Okay? I've even talked, boy, how many classes were you taking this semester? 8? Yeah. Jesus. I don't see 100% on yours. Not even close. What you doing? Did it? That's why we said drop classes, huh? Right. And who was it that was in here? Carolyn. Yeah. Carolyn Link. said? Yeah, she's great. She's great. You know. And she's no smarter than you guys. She just got it together, right? No smarter than you guys. She knows that. She wouldn't even be offended by me saying that. She just figures she's smarter or not. She works hard with you guys, so far, right? So far. So let's see what you got. See what you can do. This is a real demanding profession, and be making $100,000 5 years. Is that really? Okay. Real demanding though. All right. Anyway, so what does the balance sheet do? Reports assets, liabilities, equity. Specific date, right? It's not. How about you guys? For the year ended on a balance sheet? Are you kidding me? What is it? You close all your balance sheet accounts or what? No, you don't. You don't close any of them. It's a specific date. What do you do in the income statement, cash flow statement, equity statement? Seeing as you start at the beginning of the year, work your way down to the end of the year. It's for a year ended, right? Got it? Those things matter, okay? So, all right, anyway. Provide information about resources, obligations, creditors, equity, of course. It helps to predict what? Amounts, timing, and uncertainty of future cash flows. What are we going to use that for? To calculate the discounted present value of all the future earnings of the company, and then we're going to divide that amount by the number of outstanding shares, and that is going to be how much each share is worth. When we do the weighted average cost of capital, CAPM, the reason I like to do that in this class is it shows you what people would actually use these statements for. We are going to predict how much, when, and how uncertain the cash flows are. What does the uncertainty give us, guys? I had it up there. I tore it down. What was it? Risk. Yeah. Going to give us the discount rate. Okay? We're using this balance sheet to do that. By the way, we're using the income statement for it too. Of course. Okay? The income statement is really better for the amounts. Right? Maybe good for the timing too, not for the uncertainty so much. The balance sheet is better for that. Okay? We'll get into how we do that stuff. Okay, usefulness, computing rates of return, of course. I really don't care how big a company is I invest in. I care about, there's my recharger. I knew I left it somewhere. It was in my office and it wasn't in my book bag. Way to go. So, that's good. That's good. My wife has lots of them at home. This one's probably going to electrocute me anyway. You think so? Never touch that. Or catch the place on fire or something. Anyway, I don't really care how big the company is I invest in. I care what the percentage return is. And if it has a million shares or it has 1,000 shares, who cares? Right? It doesn't matter. If their income, if it's a small company, their income is only $100,000 a year. If it's a big one, it's $100 million or $100 billion. Maybe not that much. Okay, if it's $10 billion or something. I don't care. I only own a little sliver of it anyway. I care about the percentage return. So rates of return really matter. The value of the capital structure, what's that? Debt to equity. Right? How big's the debt? How big is the equity? What do you think? What makes you more risky?
High debt.
High debt. What about you personally? I know people that live in $1 million houses and owe $1 million. I do not think they're rich. I think they're insane. I also know people who have $1 million houses and they own the things. I think they're relatively rich. What do you think? Right? Relatively, if they have everything else that goes with that, right? Retirement accounts and stuff. If they have $1 million house, it's probably worth $10 million, right? But not if you have $1 million in debt against the house, you're probably worth nothing. Got the idea? Maybe less than nothing. Anyway, that's what bothers me about Trump a little bit. They really need to find out how much he's really worth. He's a billionaire, right? I don't know if that's true. You can't tell. He has billions of assets. What else might he have? Billions, yeah. You don't really necessarily have to show people your holdings, right? So it's kind of interesting. And not just him, but anytime billionaires are running for office, really? Probably. He's probably a billionaire, just not as much as people would think. Anyway, that's a lot of money. Evaluating the capital structure anyway, so debt to equity. Assess risk and future cash flows we talked about. And then liquidity is, can I pay my bills right now? What's the relationship between current assets and current liabilities, between cash and current liabilities, right? So like a current ratio, asset test ratio, when we did those things, quick ratio, asset test, safely. That's liquidity. Solvency is, I'm going to go bankrupt. How big is my debt compared to my equity? What do my cash flows look like? Am I going to make it? Financial flexibility is what? Do I have any room to borrow? If you financial flexibility? Absolutely. You'll get a $200,000 mortgage on that like that. Right? What if you have a $500,000 house and you have $490,000 in debt on it? You can't borrow money with it. You have less financial flexibility. So, we're looking at those kinds of things. What can you do? Do you have all your assets tied up? If I have a whole bunch of investment in marketable securities, trading securities, bill for sale securities, marketable securities, overall cash, could I sell those and get cash? Absolutely. What if I have investments in land? Oh man, land and building and equipment and stuff. A lot of people think that investments in real estate are less risky than investments in the stock market. Sometimes, right? They usually have lower returns, so they usually have lower risk. But boy, liquidity is just shot, right? And financial flexibility is shot when you buy land, building, equipment, right? So you wouldn't put all your assets into that. What if you need the money? Right? So companies do. Okay, so good. Just ideas. Okay, you can read these on your own. This is the airline industry. Boy, 9/11 really got to them. Right? But so do changes in gasoline prices. The airline industry is making a fortune right now. You guys aware of that? We thought they were going to go bankrupt. Why are they making a fortune? Fuel is extremely inexpensive, and there are very few airlines left. So they're not cutting their fares like they used to. And they're charging for everything, right? If you want to take underwear with you, it costs you $75, right? A bag, now you have to pay for it. People are going to really fly with no bags. I tell my wife we should ship at UPS. It might be cheaper. Have you? Is it cheaper to ship your bag?
Sometimes it is.
Yeah.
I mean, it depends on what you're bringing.
Yeah.
Like if I go, we had a lot of equipment for a trip that we were taking. We just shipped it out before we went.
Yeah, absolutely. If you're taking equipment stuff. Yeah. Well, I think even your clothing, you could probably do that, right? UPS is more predictable than American Airlines, I think. Does American still exist? No. Do they? United does. American still does. It's not gone yet. Okay. Anyway, Northwest is really gone because Delta owns it. Delta and Northwest are the same outfit. Yeah. So Continental and United are the same outfit, I think, right there. Continental's gone now. Yeah. Jesus. So there aren't very many. Cartel, I guess. Anyway, oligopoly. Limitations. Most assets and liabilities are historical cost. So you have land you've had for 100 years, and it's on the books at the same value that you paid for it. Why? Because that's measurable. It's a faithful representation we make. It's a reliable number. If any of us could go look at how much was paid for it in the contract, right? Or what the check was, we could determine that that number is right. Okay, what would be more relevant, though?
Fair value.
The fair value. Why don't we put all our land, building, equipment, all our assets at fair value?
Because it's hard to figure out how much unless you're trying to sell it.
Yeah, unless you sell it, you don't know what it's worth. I agree. My wife and I paid $170,000 for our house 8 years ago. Little tiny place. Yeah, we're in a mile and a half from there in the highway. Real small place. Anyway, we paid $170,000 for it. What's really funny was, of course, we qualified for over $500,000, 600,000 or 700. I can't remember. She told me what we qualified for. I said, "Oh my God, why did anybody do that? Ridiculous." My wife really wanted that house, but not really. She didn't want to be owned by the house. Always buy less than that before. Something like that. It's one investment, not diversified. What happens if something goes wrong in my neighborhood? Bottom falls out. What if I put in $500,000 versus $170,000? By the way, you know how much we borrowed? $170,000. Why didn't we make a down payment? The interest rate is 3%, you guys. I make 12 on average in the stock market. I am borrowing money at 3% and earning 12. Now, could that backfire? Sure, the bottom could fall out of the stock market, right? Sure, I could lose my job, I guess. Okay? You guys don't tell them about it. You guys maybe it would. Okay, yeah, I might lose my job, huh? But if you think about that, what's the risk of these things, right? Okay. And it's a stable market, so the property's probably okay. But there are houses in my neighborhood that are $1 million. I think those people are crazy. What do they do that for? Unless what? Unless $1 million is maybe, a tenth of your wealth. Then you might be fine. Okay? Don't put all your wealth into a house. It's insane. It's a place you live. Right? It's a cost. It's not an investment. I'm sorry, it's not. My grandparents bought a house, and people do, and they own that house all of their lives. stock market then? Over the same years? 12, 13. You can't live in stock though, right? You can live in the house, and you do have to pay rent. So of course you factor that in, right? What would it cost? You know, you have to have something. Yeah. That's the same thing. You buy yourself a $15,000 car instead of a $30,000 car. You gotta compute what that $30,000 car really cost you. If you finance it, right? All those years, and include that you could have taken the other half of the payment, right? Because you'd have your payment be don't cost as much with the 30, as the 15 probably, right? Plus the down payment, you could use that if you want. Figure out what it would be if you put it in the stock market. And then ask yourself, do you really want that car? Later, sure, when the car's immature, looks super well. But now, I see kids graduate from college, they have a $50,000 a year job, 52, whatever, and they buy a $30,000 car. Why did you do that? Okay. Didn't we teach you anything? Yeah, anyway. So later you can have a $200,000 car, it's okay. After you're worth it to them, right? It's fine. Delayed gratification is a really good thing. Well, unless it's bourbon, and then no. All right. All right. So, yeah, I got a sip of bourbon yesterday that was single barrel. 37 years in the bottle, made by Jim Beam. Tiny sip. And I didn't pay for it. So, yeah, couldn't complain. So we were estimating what that would probably cost a bottle. About 15 grand. Yeah. And you know what? It's really good. But I'm not getting 15 grand for a bottle of bourbon. Unless you're a billionaire. You know.
Buy that away from your wife.
Yeah. Luckily, she doesn't like bourbon as much as I do. Okay, historical cost, use of judgments and estimates. Think of the allowance for doubtful accounts. It's a guess, right? Think about, and the same thing with bad debt expense and an income statement. It's a guess, right? Educated guess, right? Estimate, right? How about warranty expense on the income statement and warranty liability on the balance sheet? It's a guess, right? And again, educated estimate. Okay, so there's lots of them that are that way. Even inventory. Lower cost per market, we're estimating what the thing is worth, right? So with all kinds of estimates. And then many things of financial value are admitted. You guys are aware slavery is illegal. The executives of companies, the key employees of companies, nearly all the employees of companies, really, if they're good employees, are a lot of times the most valuable asset a company has. Is it on the balance sheet? Of course not. Okay, is your reputation on the balance sheet? No. When do you have goodwill on the balance sheet? When you buy another company, you can, what, measure it, right? That's it. And then we still look for impairment of that, which is an estimate, right, going into the future. So the deal is, lots of things are estimated. Yeah, hey, we left out the value of employees. That's fine. Okay, whatever. Very cute. All right, you guys remember how to do a cash flow statement? One of the really wonderful things I've done for you, did you notice in Moodle, there is some cash flow problems? They'll look real familiar to you. They're exactly the same ones I gave you in principles. Make sure you can do them. I have been known to, on a test, give you, not that exactly, but give you a cash flow problem just like that. Can you still do it? Do you have a cash flow statement? And for our one person who has not had accounting for a while, right, be sure you do them, and I'll work through them. And anybody else who wants to work through them, of course. Okay? If you're fuzzy at all, we'll spend some time on it, okay? Do you know these definitions? Yes. We don't need to do that again, right? You already know these. You have them memorized. Did I ask you for these yet? No. Oh, I probably will sometime.
Yeah.
Here's another quiz. Oh, then there's another test. And oh, then there's a final. I have a lot of time. I'll get there. Count them. You're not supposed to just learn it for a quiz, right? You're supposed to know it for the CPA exam. Okay, now you won't remember word for word those definitions, but you'll know them still. You'll still know. And when associative memory, they give you multiple choice questions, it's a joke. Okay, or even if they ask for the definition, you can get really close. Closer than your competition, but it's really all that has to happen. All right, classifications, you know these, right? Current assets, less than a year, right guys? Or operating cycle, whichever is longer. Yeah, gotta know that. Okay. All right, current assets, current liabilities, same definition basically. Long-term investments, property, plant, equipment, intangible, other assets. Companies can have flexibility with this. They can use different titles if they want, but these are typical. Current liabilities, long-term debt, owner's equity, capital stock, additional paid-in capital, retained earnings, and what did they leave out of it they should have?
The
Other comprehensive income, sure. Okay. So you see a little departure from these major subdivisions. They might change the names a little bit, whatever it is. Okay. I've seen land, building, and equipment instead of property, plant, and equipment. So all right. What goes in current assets? Now, when you think about it, if I gave you 20 or 30 accounts and asked you what they are, this is what we're saying. Right? What are these things? Okay. What's a cash equivalent? Cash and cash equivalents. It's things you could readily convert into cash. Okay? Now, this is an interesting one because the definition, when we get to the cash chapter, is going to say 90 days or less, a security that we're going to hold for 90 days or less. Wait a minute, trading security is only 15 days, so that would include available for sale securities. Well, we don't really do that. You know, our intent is to hold it for a real short period of time, and we're not really holding it for appreciation. Not really. We're just parking the money. So you put your money in a mutual fund, or not? I'm sorry, not a mutual fund. You put your money in a money market fund, in a money market fund. So it's just sitting there, right? It's just sitting there, and you're waiting to invest it in something on a longer-term basis. Okay? Maybe you think the market is going to go down some more. So you sell, you wait for the market to go down, and then what you're going to do is you're going to take the cash and buy something, right? Like buy an investment. Okay? And you think it's bottomed out. And so companies will do this just like individuals will. And what happens is you put this in a money market fund, and it's just like a checking account, except it gives you a little bit of interest, right? Get some interest on it, okay? Or maybe it's savings accounts and stuff. So those are cash, savings accounts, still cash, yeah.
Would you count that as like interest revenue?
Yeah, it'd still be interest revenue, sure. You bet, okay. All right, and then we have short-term investments, which would be what? Trading securities, available for sale, short-term, okay? And then we have long-term investments, otherwise too. We have receivables of various types. And we'll get into that when we get to receivables chapter. There's trade accounts receivable from our customers, right? There's other types of accounts receivable, rent receivable, interest receivable, inventories of various types. You know from what County 102 that you had raw materials, work in process, finished goods, right? Okay, I'm not stressing you guys today at all. This is stuff you already know, isn't it? Just have it at the front of your brain, okay? All right, and then prepaid expenses of various types, okay? Deposits. If I make a deposit with my vendor, what's that? It's like prepaid. I mean, call it deposits, like that. Okay, then you're going to need to know the basis for valuation. Okay, fair value for cash and cash equivalents for short-term investments, usually fair value. Why? They're publicly traded. That's the available for sale, right? So we know the market value, so why don't we use it? Well, we do. Okay, all right. Receivables, usually the amount collectible, right? They are not at face value. They're not at historical cost because we have an allowance for doubtful accounts, don't we? So their net realizable value is what they really are. Okay? And then inventories, lower cost or market. You know that. Prepaid, we just leave it at cost because it's immaterial, right? Yeah.
I was just going to ask for receivables. You don't have to show the allowance for doubtful accounts. That could just be a note to the bank.
Well, it would be in parentheses typically. I don't know. I've never seen anybody do a note for it. I suppose you could. Because you can report things in the face of the statement, right? Parenthetically, you can put it in parentheses, right? Or just comma, right? Or you could put it in a note, or you could put it in support material. So you could put it in a note. I suppose there are applicants to do that. But usually it's either on the face of the balance sheet or it's parenthetical. Because it doesn't take very much room to do a parenthetical for that. Okay? So just some ideas here. And so be sure and look at this stuff real closely, okay? All right? What order should they be in? I don't care about this problem too much, but what order should they be in? From the most liquid to least liquid. What's the most liquid? Cash, of course, and then you work your way down. Okay. Usually prepaids are at the end. You don't worry about it too much because they're usually immaterial relative to inventory. So which one of these is it? B. Yeah, cash accounts are still inventory, and then the prepaids probably. Okay.
Where would you put available for sale short term?
Available for short term, I'd probably put right after cash. Yeah, probably. I don't know. If I'm going to collect the accounts receivables, then maybe they could go after the receivables, probably before the inventory. So yeah, maybe right after cash. All right, order liquidity. How about that? Okay. All right, cash. Any money is available on demand. Cash equivalents. Short-term, highly liquid investments that mature in 3 months or less. So the number is 3 months.
right? 90 days. Restrictions or commitments must be disclosed. Okay, now, restricted cash can be non-current, guys. If it's restricted, you can't use it for more than a year, right? It's restricted for some purpose, but it's still cash, right? Okay, so any cash that is restricted, which means you can't sell it, or you can't use it, rather, you can't spend it to be restricted cash. So they have cash and restricted cash investments, and then they refer to the note, and you put the description. Make you mad.
And it'll work.
Okay, let's see it. Well, maybe I'm not kidding. Have fun. Okay, note 7, restricted cash investments. Restricted cash investments consist of certificates of deposit, restricted as collateral for lease arrangements. Ah, I've got lease obligations, right? And as part of my lease obligation, I have to keep a certain amount of cash right now. I can't spend it. By the way, what if the lease obligation, they put them both under current, what if the lease obligation is for more than a year? The portion that's more than a year, that cash would be a non-current asset. So you'll see restricted cash as a non-current asset. If you can't spend it for more than a year. Make sense? This is just logical, isn't it? Don't try to remember all of this. Right? Understand. Think about it. Okay? And it'll fall in place for you. But it seems funny to call cash a non-current asset, doesn't it? But it's restricted. That's fine. Okay? With interest rates ranging from 4 to 5.5% they're making. So this was some Altera healthcare corporation there. They're probably huge. Okay, it's really funny. Okay. Here's another one. What are the other assets? That's the non-current. See it there, guys? Restricted securities. Non-current. Even though they would otherwise be available for sale, they're not because they're restricted. Got the idea? Okay, so here's the current portion, here's the non-current portion, basically, and they talk about what to do. Okay. So get comfortable with notes too. Don't just ignore them. Read the notes when they show you notes. Okay, you're going to see lots of notes. You look at financial statements. There's a balance sheet, income statement, cash flow statement, equity statement. So you got those 4 statements, and then there's 50 pages of notes. Okay, guys? The notes are kind of a big deal. Okay, it's not an afterthought, and they are an integral part of the statements. They're required disclosures. Okay, you're going to learn a lot of required disclosures. So we did this. You know, held to maturity is amortized, right? Investment in a bond held to maturity, it's the amortized cost, isn't it? Right, guys? What do you want to leave or something? Jeez, I was just getting started. All right, we'll do this. Anyway, what is it, Friday or something? You guys are lazy. I'm kidding. I'm not lazy, I'm going to work. I want to eat. Okay. You told me to get an internship, and now you won't let me go, right? There you go. Held to maturity is debt, of course. And by the way, would this be not current or non-current? Current until the last year, other than guess what? Non-current, yeah, you know, and it's going to be due, right, and you're going to collect it. Okay, and then amortized cost is current or non-current based on when. Trading, debt or equity, fair value, it's current, obviously available for sale. Current or non-current based on what? You're going to keep it for a year or longer, right? Less than a year is current, longer is non-current. All right, and then they show some examples. Just, she has to go to work too. All right. Give me, write down somewhere. We're on page number 66. Okay, we'll pick up the next. Okay, guys? Thanks for showing up today. It's a good sign. And if you want your test, I'd be happy to do yours first and give it to you. I'll get exactly. If you want to know before Monday, I'm going to do